Assalamu alaikum, ya ahla wa sahla, hayyakum Allah jami'an. Hi everyone and welcome. Thank you for joining us today. My name is Qusay Saif. I'm a partner at Sadu Capital, joined by Ahmed Tagatka and Salim Washidi, my partners at Sadu Capital, with a special guest. Ahmed will introduce him and will give you a full perspective on our guest tonight. Sadu is a Saudi Riyadh-based VC firm that invests in fast-growing tech companies. We've been investing in the early stage, and we focus on mainly B2B early stage tech companies. Today, we provide our services to family offices, high net worth individuals, and qualified investors investing in different stages, different type of opportunities. And we design this session to give you a better perspective on the opportunities locally and globally. One of these opportunities leads us to an amazing news that I'm going to share with you tonight. We are launching a new product, a new fund that invests in a pre-IPO company. We're investing in one of the largest buy now, pay later companies in the region. We're buying secondary shares, and we will talk about secondary shares in this presentation. In addition to, inshallah, a full-fledged report we're launching this month with the Venture Capital and Private Equity Association. Would love for you to reach out to us. Would love to talk about this investment opportunity with you. Please reach out to me via my email, my phone number, my LinkedIn, and my X account. Would love to talk to you, explore opportunities, and especially this buy now, pay later opportunity. Without further ado, I would love to transition to you, Ahmed.
Thank you, Qusay. Hi, everyone. I'm اسمي أحمد طقاطقة, partner at Sadu Capital. I'm really excited to introduce our guest today, Kyle Stanford. Kyle is the Director of Research at US Venture and PitchBook, where he oversees a team of analysts covering the US venture market and contributes to PitchBook's global venture research. In addition to his work in venture capital research, Kyle has developed PitchBook's coverage in areas like non-traditional VC investors, venture debt, and the evolution of venture ecosystem and growth equity. He's also a key voice behind the core quarterly reports and outlooks published by PitchBook. You've probably seen his work quoted in places like the Wall Street Journal, Financial Times, and on TV segments like CNBC and Bloomberg. When LPs and GPs want to understand what the numbers say about venture, Kyle is the one people listen to. Thank you so much, Kyle, for joining us today.
Yeah, thank you so much for the kind introduction as well. Happy to be here. Let me just share my screen real quick. For those of you that don't know PitchBook well, PitchBook is a data provider for the private markets, PE, VC. We cover M&A. We are wholly owned by Morningstar, which is a US public equities and global public equities data provider. And so we are able to provide the full suite of kind of private market and public market data. I sit on the institutional research group, and so what we try to do is act as a equity research desk for the private markets. And so we take our data and uncover trends, talk with clients about different strategies, and hopefully, provide the insightful analysis to the market that is kind of missing from private markets. So before I get started, really going to the slides, I want to talk about some of the 4 key trends that we have really been following in VC in the US and globally. Liquidity remains a big challenge, for VC. And when you hear about the secondaries opportunities, that's a big reason why you're hearing so much about secondaries, because IPOs, traditional M&A, is having a big, is very challenged globally, whether it be because of the high valuations that have been paid in private markets in 2021, or simply because of kind of a macroeconomic uncertainty or instability in some markets that is really challenging that M&A. But so 500 billion exit value generated in 2025 up through middle of December is the highest we've seen since 2021, which is a huge positive. Not all of that is rosy, right? The 500 billion in total exit value is less by about $350 billion than was in exit value was generated in 2021 in the US alone. And so, the 500 billion is somewhere around 40% of the record from global exit value in 2021. So a long way to grow back. Returns is also challenged because of that. We look at the last 5 vintages of VC, all are underperforming the S&P 500 in many public markets, right? That's obviously going to be a little focused on the US returns there. But again, the liquidity for the last 5 vintages, not that you would expect much DPI coming out of a 3-year vintage fund, but it has been difficult. And that has really weighed heavily on fundraising. So we are seeing a fundraising drag in global venture markets, which will have some impact on activity in the next couple of years. But kind of shifting and kind of going against the fundraising and activity theory, deal activity is rising in the U.S. and it's starting to see some pickup in several markets around the globe, particularly because of AI. And so we have mega caps in the U.S. public markets heavily investing in AI. You've got almost unlimited number of new companies with specific areas for their AI model to be used coming into the venture landscape and raising funding. So we're starting to see this bifurcation in the market where you should have lower stalled deal making because of the lack of liquidity and lack of fundraising, but it's starting to diverge pretty quickly. Before I start, I do want to just kind of look at the asset allocation that we've tracked over the past couple or 20 years, right? We know that the public markets, especially in the US, are declining, right? I think the stat that everyone likes to throw out is that in 2000 there were some 8,500 public companies in the US. Now there are fewer than 4,000. And so when you see a big drop like that, the question is where the money is going. And you can see the private equity, which includes venture capital in this, has more than almost quadrupled in the asset allocation percentages from this is from public pensions in the US and where they're putting their money. But you see other kind of long-term asset classes, real estate, even hedge funds significantly increasing their allocation from these investors. And then you see fixed incomes declining relative, and then public equities falling quite a bit. This is something that we, with Morningstar as our main backer, really look at. It's kind of like the convergence of public and private markets, right? It's the redistribution of allocation from large LPs into these new asset classes. Not everything is as liquid as it's going to be in the public markets, but what these, long-term focus LPs are looking for is that long-dated illiquidity premium that venture and private equity and some of the other asset classes can provide. This is just another look, and these is from state and local pensions in the US. And so these are going to be smaller, probably more risk averse or LPs, and looking at their allocation is still much of the same, right? If you look at the public equities and fixed income, you see those decline pretty significantly over the past 20 years, while real estate and private equity again start to increase. And so even these smaller LPs in the US, we start to see them really leaning into the long-term illiquid markets to increase that absolute return and that long-term return for their portfolios. And this is a quick major reason why private equity has seen so much. And this is again private equity and venture capital split out, but up through 2021 the returns of these two strategies was the highest in the private market and almost on an annual basis higher than what we were seeing in public equities. And so this did cause some problems because of the strong returns, right? It brought a lot of new LPs into the space in 2021 and kind of overcapitalized many of the VC firms and companies that we saw in the US, as well as some emerging markets. Latin America had a lot of, almost quadrupled the amount of capital there. So what we're looking at now is, even though VC has performed relatively mediocre, I guess would be one way to put it, over the past 5 years, we are seeing a rebalancing of the venture portfolios. And so there are these LPs that have been in the market for a long term, really diversifying within the venture strategy. We're also seeing a lot of LPs that maybe kind of over allocated to in 2021 and through kind of the ZIRP era, reallocating and strategizing how they're putting money into venture. And it's gonna be a much more deliberate strategy that we've seen than just everything going into one or two funds like we saw in 2021. But if we get some of the global venture trends, right? Again, I wanted to start with the liquidity, and this is just a look at how liquidity has trended for VC over the past 5 years, right? You see the $1.5 trillion in exit value generated in 2021 was this, enormous win for the market, right? We had SPACs that were providing a lot of liquidity to, small or mid-sized companies. You had public markets globally that were accepting and supporting companies moving from private to public markets. The M&A market was incredibly high with the low interest rates across the globe. Corporates were major buyers, and so that was a huge win. Between 2020 and 2022, we saw the AUM of venture more than double, which I think is when we get to one of the challenges, right? That was a steep increase in the market within the unfortunate circumstances of everything kind of falling off in 2022 and leveling off and having everyone be over allocated to venture. So as we've seen, even as the global economy has not been nearly as bad as maybe everyone expected in 2022, money is still redistributing around venture, right? And so we're seeing some in APAC redistributing to different countries and different markets. We see the different fund strategies being changing within the US as well. What I really wanted to point out too is kind of this rebound that we've seen in 2025. IPOs have not been where the money has come from. We have seen an uptick, right? You can see here 267 companies have gone public, somewhere around 250, 300 billion in exit value generated through those companies, but it's nowhere near where we saw in 2021. That kind of like diverges with the narrative that many people have heard about IPOs this year. I'll even point to the US IPOs, where from a count basis, 2025 is about to be very, very on par. We might see it exceed 2024 by a couple IPOs by the end of this year, but only 87 billion in exit value was generated through IPOs. And so it's kind of diverging from the market when you hear Figma and some of the large companies have gone public, which have been great. It has not been nearly as high as it has been in the past. And for context, as you can see, almost 200 companies went public in 2021. And so there's a long way to build back for the US IPO market. The only question is, where is that money coming from? Secondaries has been a major kind of beneficiary of the lack of liquidity, right? And so we have seen this direct secondary, so secondaries in directly into companies, some stakes from other investors being sold, increase substantially. We actually think that in the last year, this has grown by about 100%, from around 40 billion to 80 billion, and we are probably undercounting that quite a bit. Where we do see a lot of the activity occurring is in tender offers alongside primary shares or primary raises from companies right now. We do see a lot of activity on equities and Forge, some of the other markets that have tried to set up an exchange style area to trade these secondary shares. We do see GP LEDs also increase a bit. I think in the US it's difficult. There's a lot more restrictions on VC funds setting up these continuation vehicles. And so we hear more about the continuation vehicles in other markets. APAC especially, there's been a lot of talk around continuation vehicles for VC funds. In the US, there are some of the large firms are going to be able to do that. Industry Ventures has set up a couple, and so it's starting to gain some momentum, but still some hurdles there. You compare this to the IPOs and public listings, this is even including some of the SPACs that were completed this year and acquisition. You can see how much how big of a part secondaries are playing in the liquidity market right now. So we talk about them being underreported and undercovered. They are very concentrated in the US, really from a strong secondary standpoint, probably the top 30 to 40 companies. On the right chart here, this is just a look at how that compares to the aggregate value of unicorns, right? And so just companies that are valued $1 billion or more. It's only 2% of the pie here if we look at how big the group of unicorns is now valued. In the US, unicorns are valued about $4 trillion. SpaceX is 800 billion and OpenAI is 500 billion. But we still have 4 trillion in exit value in just 875 companies. These companies have also been held for a very, very long time on average, right? Rather than the 10-year fund term, these companies have been held for 15 or more years in some cases. And so the need for liquidity from whether early employees or early investors is a serious need for VC. And so we see secondaries building up a lot. But this is a look at kind of some of the trading on premium and discounts on equities then, right? And we have seen a growth back, but many of the companies are trading at discounts, which I think says two things. One, for equities then, they're not going to have necessarily OpenAI shares or some of these really strong companies at the capacity that is needed. Those ones will be trading at premiums. We do see a lot of companies that are on these platforms trading on discounts because there is a misbalance between the need of liquidity from the investor and where this buyer is going to want to get in. Right? Obviously, buying these companies is going to be tough to pay a premium with the liquidity market right now. So many sellers are asking for discounts. As you can see here, it's been pretty unbalanced toward discounts in the market. But look at global liquidity, right? Obviously, where we look from VC standpoint, North America is active about 50% of the VC market, right? From deals and exits, North America is still driving a considerable portion of the exit value. Where we've seen a decline, APAC, China has had many challenges to its VC market, and some liquidity is kind of drying up there for now. We do see India starting to build back and have a more active IPO market, which should drive liquidity for some investors. Much of it is still really contained in North America and Europe.
Middle
Yeah.
East is part of Asia or part of the rest of the world?
So Middle East is going to be part of the rest of the world there. Asia is typically just mostly the Pacific coast of Asia, and then it's obviously some of the Central Asian countries as well.
Thank you.
One of the positives that we do see in the market is that we are starting to see venture build back. We're starting to see AUM and the net asset value of global venture grow back. We're starting to see our strong returns, and even though those IPOs or liquidity markets have not been as strong as maybe everyone would want them to be yet, we are starting to see positive quarterly returns for VC funds globally. One of the challenges too the market has had is, again, the lack of fundraising, which I'll get into, but you can see in 2022 the drop in the net asset value of the market and the challenges that had with returns kind of locked everything up. And so we do see a lot of funds have stopped raising, moved their raise from 2022 to even into 2024. And as these returns start to build back, we do expect to see some growth back in the fundraising market globally for VC. We look at our returns too, and I will note I do have a report that I will be able to share with all of you that has actual IRRs and quartiles built out for different markets for venture. But we look at the returns of North America and Europe, and you can see, how muted it has been over the past 4 years, but how strong the returns were in 2021, right? I always say that 2021 is not a market that we will likely get back to anytime soon, nor is it be one that we should compare many of the markets over the next few years to. But we talk about, again, the growth of private markets. A lot of that happened from 2014 through 2021. Some of the best vintages that we've seen are actually 2011 and 2012 vintages. They were able to start investing when the market was small and really ride the entire bull market up through the end of 2021. Fundraising activity has been low, right? And I think this is the problem or the challenge that you get with the lack of liquidity. Without that money to recycle into venture, LPs are much more wary to put money back to work in funds that haven't been able to provide liquidity. Right now, globally, 111 billion has been raised. I don't need to explain how much worse this was than 2020 or 2022. What it is doing is consolidating the pricing power of the market into the investors that do have dry powder and the investors that do have the ability to make deals. We've seen a lot of the emerging managers that raised in 2021 or 2022 not be able to come back to market because, as I mentioned, the last 5 vintages have very low DPIs. The inability to show a track record, inability to show the access to some of the top deals right now is been a turnoff for LPs. And so, as this moves forward, and again, I talked about the increasing deal activity, the firms that have dry powder and ability to invest right now are in a very, very good spot to be the next 2011 vintage or 2012 vintage funds as the AI wave kind of continues to build, and hopefully the market is building out of the slow last 5 years. Again, we look at where that money has been concentrated. A lot of it has been in North America and Asia, actually. Europe has been one of the, compared to its deal activity and compared to its liquidity activity, has typically not been able to raise the large funds that you've been able to see in the US and in Asia, right? And especially within China, there's a lot of VC investment going on for investment locally, but also we do see some, and maybe not so many of the past few years, global investors headquartering in Hong Kong and being able to invest into Singapore, into China, into the US and elsewhere. As we look at the next 5 years or so, where we think about the pricing power for the investors that do have dry powder, those in Asia and those in North America, particularly in the US, do have the capital to start to build. where we have seen, talking about just kind of the Middle East being in this, rest of world where it has been pretty low. We do see a lot of LPs investing into funds that may not be headquartered, right? And so if they may not be headquartered in the Middle East, but maybe invest into the Middle East, they're not going to be captured in that way here, right? So these are always tagged into the headquarters of the firm, whether it's the US or in Europe or in the Cayman Islands or somewhere else. That's where that will get tagged. And so it's not always the best representation of where money is going, but it is an interesting way to look at where these, capital funds are being located. Going back to deal activity, right? And this is global. And so it actually doesn't present itself necessarily, as I was saying, as this kind of bifurcation, but where we've seen in the US, deal activity is starting to build back very, very significantly. In the US, we have about half of the deal value. This 509 billion has been invested into the US. You look at OpenAI raised $40 billion, Anthropic, XAI, made these large foundational models raising tens of billions of dollars. A lot of the money has gone there, but from a deal count standpoint, we do see this as a very, very strong year in the US. Where this deal value or deal count has been kind of held back in this global view has been some of the markets that were big in 2021 and kind of drove a lot of investor interest, but have not been able to provide the liquidity. Latin America has seen a significant decline of about 50% in deal count. Southeast Asia has had a decline of about 50% deal count. China has been, China drives about 50% of Asia's deal activity. They have had a decline of about 50% from the 2021 high. And so where deal value, deal count is being held back in some of the markets that do have that dry powder, US particularly, and where some of these large, foundational LLMs are being built in the US are seeing heavy amounts of deal activity at the moment. This is, I always say, laugh and say the chart on the left is one that you would see in 2021, where everything was a new record and a new deal count high every year. This is just AI activity, right? And so you can see how the investor base of VC has really focused and kind of not necessarily retreated to, but refocused their efforts on AI. What we do see is companies that are not able to drive an AI story or not able to show how their AI is making their business model more efficient have had a really difficult time raising. 55%, almost 54.5% of the deal value has been invested into AI companies, 31.5% of deal count. In the US, in Q4 or up through December 11th, we've seen 40% of the deals be in AI companies and 65% of the deal value has been in AI companies. So it's hard to position away from AI at this moment as every investor is kind of looking at there. And I do want to say it's not necessarily a singular sector, right? It's not something like oil and gas. It's not something like even life sciences. It is being used in B2B SaaS. It is being used in life sciences. It is being used in climate solutions. And AI is just kind of being used everywhere. And so it just ends up being a bigger kind of industry when we look at it that way. But in the US, again, it's basically if you are not able to harness an AI story, provide it in your business model, it's tough to make that investment, raise that capital.
It's the same case in Saudi as well, and the MENA region. It cut across all sectors. There is a lot of excitement from LPs, GPs, founders as well. And it's one of the buzzwords that is not gonna disappear soon. Like
Yeah.
we've seen waves of big data, IoT, crypto, Web3, but this one seems everyone is doubling down on it.
Yeah. I mean, all the way up in the US economy, right? You look at Microsoft and Apple at the top, they're trying to find a way to harness AI. They are, you know, laying off large swaths of their employee base because AI can do many of the jobs. They're looking to find efficiencies in every aspect, and it's using not one AI, it's using and maybe 5 different AIs in every single department. So what that does, as every corporate in around the world, as they try to harness AIs for all these different use cases, it provides a huge number of opportunities for new companies to be developed and new AIs to be built, which I think is one of our outlooks for 2025 was that, early stage financing was going to be at a almost record high, or if not almost record high, because the opportunity for AI is so big. You see companies being developed for relatively low low cost. They can be developed and deployed quick as a SaaS model. And so kind of everything that VC investors have wanted to always invest in is kind of wrapped in AI. And so I think it'll be really interesting to watch for the next few years. This is global deal counts again. You do see the US, North America, but mostly the US and Asia driving a lot of these deal count figures. India has, I think I mentioned before, has started seeing deal counts pick up and really close the gap with China from an APAC standpoint. Japan is another strong market that we do see. We know that there's a lot of activity across the MENA region as well. And so, deal activity has stayed relatively strong. I would expect with our lag data collection, 2025 globally to come in as probably somewhere around 2023 and be well above where we were before the 2021 kind of growth. And I do think there's a lot of markets that are really primed, right? What do you need for prime growth? You need access to local capital and access to growth capital. You also need access to high tech industries and the ability to drive that and then want the desire to drive high tech capabilities by governments and whether it be state, local, statewide. So I think APAC has a large number of opportunities or opportunistic markets. I think the U.S. again, with its low, amount of capital available here, is going to be another really strong market for 2025. So I know there was a lot of data, and a lot of it was very high level, right? And so, I have a couple of reports that my team has put out that we'd be happy to share with everyone on this. I know that we have some questions and happy to go through those with Sadu Capital and make sure that anything else gets answered from the audience.
I do have a lot of questions for you, Kyle, but let's start with Salim.
Many thanks, Kyle. Amazing insights and stats. And by the way, would definitely love to share with the audience all the reports done by you and your team. Would love to open the door for questions by the audience, but I want to take the advantage and have the first question, if you don't mind. You mentioned amazing stats, Kyle, about fund performance. If we look and deep dive into the typical fund performance metrics like the IRR, TVPI, DPI, do you see dispersion in those performance metrics based on fund vintages, Kyle? Do you see certain vintages, especially in the VC space, performing differently? What factors do you attribute those differences, if there are?
I think looking at vintage performance rather than just the performance of specific investors, I think is very interesting, right? Because you can sit there and say, Sequoia Capital or Andreessen Horowitz is the best investor, and that may be true. But if you look at across their funds, they have great ones and they have mediocre ones. And if you track those mediocre ones to where they are in the market, they still might be top quartile, but it's what happened during that vintage that has been a challenge, right? So I think the easiest place you look is the last 4 years. Obviously, these young vintages are going to have very wide dispersions because they are so new. But the top performing funds over the past 5 years still have very strong IRR because they've been able to get into the companies that have been able to raise at maybe in AI and very consistently higher valuations. But if you look back, 2016, 2017 was a tough year, and you saw a very wide dispersion of returns there. You also see top quartile figures that are lower than what you might have seen in vintage 2014 or 2015. Some of the top vintages that I mentioned before are our 2011 and 2012 vintage funds, where you're going to have a median IRR on those funds that's going to be higher than top quartile on some of the other vintages that struggled. So when I talked about the recalibration of LP strategy into VC, I think making sure that these LPs have a very deliberate allocation to each vintage, right? Again, you could be in a median vintage fund in 2022 that's going to outperform a top quartile vintage from 2020 or fund from 2023 and so on. And trying to pick and choose a certain vintage and then wait for 5 years makes it really difficult to kind of time the market because we don't know what the next 3 years or 5 years or 10 years will include, right? And so even missing a fund by a vintage or two can really have a significant impact on the returns. So again, the last 5 years have been a struggle. 2016, 2017, with some of the geopolitical uncertainty and lack of IPOs that year were tough years that we've seen from kind of a vintage perspective. Obviously, going back to 2008, 2009, and 2000 vintage funds, those ones all have struggles for very obvious reasons.
Let me throw a second question, if you don't mind as well. When we speak about realized versus paper gains, from the data points collected by PitchBook, how much of the value in VC today, especially in recent vintages, let's say in the last 5 years, is still unrealized versus already distributed?
I would say a very significant amount of it is unrealized, right? And so one of the, I think everyone wants to, it's been one of the challenges for the venture market, right? As these companies stay private longer, whether it be from just a year's perspective or a valuation perspective, it creates this ballooning of kind of the net asset value of the market. In the US, I mentioned there's about 4 trillion in unrealized gains held in just 875 unicorns.
Wow.
So even when we look at, returns, for funds in the US, we have seen it's about a median of 9.1 years from fund inception until 1.0x DPI. And even in some of the other vintages, right, I think it's like 2013 or 2012, when that fund hit, when that vintage hit 10 years, there was 2.7x remaining value in those funds and just over 1.0x in distributed value. And so one of the challenges that VC, I think, has really tried to work on, and secondaries are a major part of that, right? It's easy to sit here and say, these funds take 10 years to get 1.0x DPI. But if these funds are able to start accessing secondaries 5 years in, 7 years in, 10 years in, the gap between that, illiquidity can be kind of jumped over a little bit, right? It might not be, you might have to get out of some of these, hopefully not SpaceX or someone else, but you might have to get out some of these companies a little earlier than expected. But if the returns are strong and you can get a 10x return in 5 years or 8 years, I think that's something that a lot of these VC investors are going to want to start doing. And secondaries provides a lot of opportunity for that from buyers and sellers to continue these strong returns, even as companies stay private for 15 or longer.
But if that's the case, Kyle, if most of the VC return is today trapped in unrealized gains, how should LPs then assess GP track record if they want to invest in a second fund or a third fund by an emerging manager?
Yeah, I mean, I think it's tough, especially investing in a second and third manager as these companies stay private longer, right? But I think as you look at even a first fund or a second fund and assess it, it's how those companies moved along in that life cycle. Has a majority of companies already come back and raised another round at a higher valuation? How is the makeup of that? Is it concentrated in a single sector, or is it distributed across and having a wider swath of companies moving forward? So I think there's a lot of due diligence to be done on those unrealized gains that provides a lot of information for LPs when they're looking at a fund for their second fund or third fund, right? Obviously, in the past, a 10-year fund term cycle was great. If that is extending out to 12 or 15 or longer, it's going to be a lot longer to be able to look at those realized gains. But unrealized gains can provide a lot of information for LPs in a very similar way to what you would look at from a cash distribution without just having that cash sent back.
I want to take advantage of this and ask my questions if
Please
you don't
go ahead,
mind.
Ahmed. Sure.
Okay. So, Kyle, you talked a lot about 2021 and how maybe SPACs was one of the big drivers of the big exits in there. I'm worried that secondaries will be the new SPACs I want to ask you about the signals that you saw maybe before 2021 that led to that big spike in 2021. Did you see any signals leading to that? And if are we seeing similar signals today? Because with the new tender offers, like tender offers are becoming the new IPOs. With the structured liquidity windows, with what's called now the secondary private offering, SPOs instead of IPOs, which is great. I love secondaries. I just want to try to find if there's any signals that are leading to a bubble in a specific activity in the market, and how can we avoid that?
So I think the comparing everything to SPACs, and I think SPACs are something that everyone should be worried about not happening again. But what those companies did and why they were able to provide something is when they were going to combine with a company and take them public. The beginning, they were able to sit there and project out what this company's next 5 years would be, whether that was based on great information or mediocre information or lacking macroeconomic input or anything like that. That's what you can't do that in IPOs, right? You can't sit here and be like, we're going to go public and in 5 years, 10 years, we're going to be this. And so you should buy us now. So there was a very large misalignment in what the companies were and what the investors in those SPACs thought they were going to get. Once that regulation changed and you were no longer able to go and project out future performance of the company, SPACs basically disappeared. All right, so if we look at now what secondaries are going to do, obviously there's going to be, hey, this is what our growth has been, this is where the company is expected to be, but you can actually do a lot more due diligence on these companies at some point. And I think there's also just need to do a little more diligence on, hey, like I'm not going to pay a 30% premium for these companies, right? Everyone wants to be in OpenAI and everyone wants to be in SpaceX, but paying a premium on some of these companies is probably not a great idea. Where we do see kind of a change too is that secondaries have been really concentrated in companies that are raising primary rounds. And if they're raising a primary round and maybe a secondary alongside or tender offer on side, that's a positive because that means there's equity interest from other investors who, for better or worse, do this for a living, right? And that's what their job is. We're also seeing it very concentrated in the top 20, 30, 40 companies, right? That's where most of the tender offers are occurring. If you're getting in a top company, I think there's a level or relatively less risk than what the SPAC companies were buying, because they were not buying the top companies in the market. They were not taking your SpaceX's and everyone public. They were taking companies that were struggling to raise primary round equity. They were taking them public and generating liquidity for their investors on basically a future projection that wasn't necessarily based in kind of the economics of the market, right?
Yeah, the fundamentals.
So secondaries, I think too, right? There's obviously going to be a negotiation process, right? And it's like we've heard from people, it's like bargain hunting in secondaries is not what you should be doing, because those are the companies that SPACs would be taking public that are not going to really be able to raise that primary round. And so if they're being sold at part of the last round or on par with a company that's raising primary, there's a lot more avenues for the due diligence, a lot more hope and comfort in that there's equity investors that are paying a that price for primary shares. That's why I see it being different from the SPAC kind of revolution in 2021.
That's actually music to my ears. It means that secondaries are safer. It's not FOMO driven. People are being more cautious while doing secondaries. Qusay, you wanted to ask something?
Yeah, I enjoyed the presentation, but there were a few slides in the beginning showing a change after 2021, I believe, in fund raised and deployment. There must have been occasions in the past where that happened multiple times. I don't expect you to have every answer, but what usually happens after such a spike like 2021
Sure.
in the following years to recover? How long does it take? How impactful? Although even this year, we a lot of people are talking about the AI winter that is about to happen. So is that even going to change? The history repeats itself, but this time it might happen differently. So we're all speculating, but you've been
Sure.
seeing the data, you're closer to the information. Would love to hear your thoughts on the topic.
So I think there's two very obvious places to look, right? There's obviously the dot-com bubble in 2000. There's a global financial crisis in 2008. The other one would be kind of like that I mentioned earlier in 2016, 2017, there was a kind of lack of liquidity for, just about a year. That one was much more mild, right? There was just some kind of geopolitical uncertainty and things going on with China and the US that caused a lot of disruption to public listings. That would kind of, the next year was kind of 2018 was at the time a record year for IPOs and unicorns were off to the races. If you look in 2000, when the market crashed, how at least many people have been trying to compare now to then is that was a tech bubble. If this is an AI bubble, it should look the same. But what we see right now is that companies are generating revenues off of AI. When many of the companies that were kind of building in the tech bubble were not generating anywhere near the types of revenues that companies were now. And so when the market fell out there was a lot of companies that were left without the ability to even finance themselves. Obviously, someone like OpenAI is generating a huge amount of revenues and losing a lot of money. And so I think that's some place that we see some challenges. But in 2000, you didn't really have a time. The market was much smaller globally, in the US as well. It was much smaller. And so you didn't have much time before the global financial crisis came to build back and see a spike in growth. In 2008, it was about 4 years from the market crash to when liquidity and IPOs for VC-backed companies got back to even with I believe 2008 was the high year. So it was about 4 years. We're about 4 years in now, right? Again, where this has been a different kind of slowdown though is that it was not macroeconomic event that collapsed the economy. It has not even necessarily been a horrible economy in any way. We see a lot of companies continuing to grow, but what the challenge has been is that the value or the prices that were paid in the private market in 2000 or 2020, 2021 with the very low interest rates were way too high. It also helped those companies build to a point where they were able to start, for better or worse, offload company shares through secondaries and provide executives with the compensation that they didn't need to be pushed to IPOs. And so it kind of threw off the mechanics of what traditional venture had been. If we think of 2026 and what the global economy looks like, I think it probably looks a little less sturdy than maybe 6 months ago, but there's not any reason to believe that there is a bubble that's going to burst and kind of collapse all this AI investing, right? I think an AI winter, if that's what kind of we went into and it led to lesser funding, would be a relative positive, and it would start to separate kind of the true winners from a bunch of companies that are raised on kind of hopes and dreams. But I don't see any major global event, right? Obviously, those can kind of come out of nowhere, and so it's not necessarily my prediction to say yes or no. But I do think at 4 years, what we've seen last year was we saw someone like Klarna and Figma go public without raising a lot of primary capital. And so what that told us was that a lot of the shares were being sold by existing investors and kind of a push and a need for liquidity. So even though there are secondaries and they provide a lot of window, we talked about the unrealized value in venture. There's a lot more that needs to be released. And I think that push to liquidity gets a lot of these companies starting to go public this year, right? If SpaceX goes out at a $1.5 trillion valuation, which is, would be really crazy, I think that starts to bring more companies, kind of the hope that they'll be able to support their value and some probably stronger companies than we've seen in the past few years. So I think, comparing it to 2009, 4 years in, you start to see IPOs get back to even. I don't think we're going to get back to even IPOs this year at 200 for 2021. But if we get back to what the average IPO market has been in the US on a monthly basis, for the past decade, it's about 6.5 companies. And so that takes us to 65 to 75 companies going public, which is a 50% increase over this year, which is a big positive for VC.
Any data by PitchBook collected on whether performance of VC funds differ by geography? Why I'm asking this question, Kyle, because the notion is that US drives most of the VC return. And that's why there is a huge appetite by LPs and investors in general to deploy or invest in the US-based startups. Any PitchBook data collected that draws a picture on this topic, Kyle?
I mean, I did have the one chart in there, right? And so most of our returns data is going to focus on the US and it's going to focus on Europe, right? If you look at between the US and European funds, there's a pretty strong correlation and almost similar returns on both of those regions. I think too, one of the interesting things about VC is that even if, the US, let's just call it the front runner for, better, for right or wrong, right? But if they're ahead, what has happened is now after the companies are developed here, they can be developed with a more kind of local flair in other markets around the world. And so you start to see US companies and business models be deployed in China, which are then deployed in India, which are then deployed in Indonesia and the Philippines and similar markets. And so every market as is kind of developed through this cycle ends up being a couple years behind. And so these returns can probably be enhanced off of, right? If you look at, Uber was built in the US, and then you had Didi in China, and then you have Ola in India, and you have, Gojek in Indonesia and a couple other ones and Grab across Southeast Asia, right? You can follow these business models around the world, right? And so, I think especially looking at emerging markets, the returns from those markets can be really, really strong because you can look at what business models have worked and then what business models and businesses are going to develop those within that market and make them kind of more efficient for that region. And so I don't think necessarily that funds need to go to the US to generate the returns, right? And the returns from Europe will show that. I think as you look at more local capital, the investors that are well versed in kind of the businesses and development of other VC markets that may be a couple years ahead, and are also very well versed in the needs of the population and businesses within a region, can really create a lot of strong returns off of kind of that beforehand knowledge. So again, the returns we do have are going to be US and Europe based, and they show a very similar pattern, and not having the US have wildly better returns. I do think the more regional funds in the emerging markets have a very big opportunity for strong returns over the next 5 to 10 years.
I want to be respectful of your time, Kyle, and the attendees' time. I think we have 4 more minutes. Salim, I think there's one question in the
Exactly,
chat.
yes. By Abdulaziz Al-Auf, he asked an interesting question. He asked, in order to evaluate VC performance, do we have historical benchmarks on return on invested capital per market?
Yes.
Okay.
So one of the reports that I will share to be sent out is our global benchmarks report, and it looks at all the different multiples by region, by fund size. There will always be a benchmark, right? And so if you want to compare it to the other VC funds, you have that. Every fund should have a benchmark, though. Are they trying to beat an S&P or try to generate private equity style returns by investing in kind of later stage companies? So I think there's a lot of different benchmarks that can be used. And I don't think that's necessarily a good answer for this, but I think the evaluation of VC performance should be done on the benchmark that the fund has kind of set out from the beginning, right? And so we look at the VC benchmarks, which are, ours are modeled to be similar to what Cambridge Associates puts out, and we provide all the underlying funds that are in there to take a look at those. And so we can look at MOIC returns by vintage. We can look at IRRs, DPIs and multiples. I think especially now are very important for assessing fund returns. And so we take our to look at 2021 vintage funds, which you wouldn't expect to have mass amounts of DPI. What we have done is look at what past vintages have done by year 4, year 5, and kind of so making sure that you were assessing it in many different ways and looking at those funds, I think is the best way to do it. But picking a style of benchmark and using that, and if you're looking at individual funds, understanding the benchmark that they are looking to hit, whether it is a VC style return or a P style return or beat the S&P 500 or anything like that.
Kyle, it's
Yeah,
been a wonderful time with you. Thank you for giving us the time, sharing with us these amazing insights that leaves us thinking about what's about to come, and would love to share those reports with our audience today. Thank you, our audience, for giving us the opportunity to share with you this amazing session with Kyle and PitchBook. We look forward to really doing this again and again with you, Kyle, on different topics that you feel of great importance to us and our audience. This is one of many, inshallah, to come. And we look forward even to seeing you in the region whenever the
yeah,
opportunity allows.